Welcome to Killik & Co.'s Wealth Planning video. Today, Sarah Lord, Managing Director of Killik Chartered Financial Planners, will be discussing the key financial planning points for those who are starting out in their careers. Sarah, it's well publicised that there are increased pressures on a young professional's finances these days. What are the key areas that you find clients require advice on?
As a young professional, there are indeed many pressures on your finances, which typically include repaying any outstanding student debt, building an emergency fund, and saving for the deposit of your first home. Each of these pressures is normally equally important, and therefore it's essential to strike the right balance from outset. Working with a Killik Wealth Planner to identify your financial goals, prioritise them, and then put in place a strategy bespoke to your needs will assist you with ensuring that you're giving your financial future the best possible start. Many graduates now leave university with average debt of £20,000, which is made up of a combination of student loans, credit cards and overdrafts. Such debt can feel like a large and threatening sum, but with a common sense and sensible planning, the shock of such debt can be alleviated. The key is to start repaying the debt as soon as possible, particularly as the interest rates charged on overdrafts, personal loans and credit cards are typically in double figures. Small but regular payments, ideally above the minimum payment required, can normally be the best approach. Debt is best tackled by proactivity, such as setting a budget, cutting out extravagances and spending sensibly. Taking these simple steps will help reduce the outstanding debt over time.
That covers debt, but you also mentioned building an emergency fund. What does that mean?
Essentially, an emergency fund is designed to provide a safety net. It's an amount of money held in a bank account to pay for any unexpected large capital outlays such as repairs to your car. It's advisable to hold 3 to 6 months net income on deposit as an emergency fund. Therefore, whilst looking to repay student debt, it's prudent to start saving cash on a monthly basis into a bank account so that an emergency fund gradually accumulates. It's important to maximise tax-efficient vehicles available to you, and therefore when building up your emergency fund, it's prudent to make use of the annual cash ISA allowance, into which you can save up to £5,640 for the current tax year. Most banks offer cash ISAs with instant or easy access for such an emergency fund, and a Killik Wealth Planner can help you identify the most suitable one for your requirements.
The other key area you mentioned was saving for a deposit on a first home. How can first-time buyers achieve this?
It's widely publicised that it's becoming increasingly difficult for first-time buyers to get onto the property ladder due to a combination of stubbornly high property prices and, since the credit crisis, the lenders being more stringent on their lending criteria. According to Halifax, the average house price for the first-time buyer is £122,389. And lenders typically now require at least 10% of the purchase price to be put down as a deposit towards the house, which means based on the average house price, a deposit of at least £12,000 is required, plus the costs of moving, such as stamp duty and solicitors' fees, means that individuals often need a minimum of £15,000 to buy their first home. Of course, for those that live in London, the typical house price for a first-time buyer tends to be higher than the national average, and therefore it's more typical that minimum deposit of £20,000 is required, and the total cost associated with buying the first property is more likely to be in the region of £25,000. Therefore, as well as repaying debt and accumulating an emergency fund, if you're looking to buy your first property, you need to earmark an element of your income to save towards this financial goal. A tax-efficient way of saving for a deposit is to make full use of your annual stocks and shares ISA allowance. A Killik Wealth Planner can assist you with deciding on the most appropriate strategy and will work with a Killik & Co broker to ensure the underlying investments are aligned to your attitude to investment risk and time horizons. Although, of course, investing in stocks and shares does have risks and is not suitable for everyone.
With so many pressures on the finances when you're starting out on your career, I guess many people put off retirement saving.
Whilst retirement seems a long way off, the sooner you start saving for retirement, the easier it is over the years. Most employers offer a pension scheme for their employees and make a contribution into this plan. In the majority of circumstances, it's in your best interest to join your employer's pension scheme at the earliest opportunity to ensure that you benefit from the contributions that your employer will make on your behalf. The impact of delaying saving for retirement can be significant. For example, if you saved £100 per month into your pension fund for the next 20 years, the fund could be worth £46,791 at the end of the 20 years. However, if you delayed saving into your pension by 5 years and then saved for 15 years, the fund value would only be £29,607. A Killik Wealth Planner can advise you on how best to plan your retirement savings, what contributions you should make and the best pension plan to save into.
To find out more about how Killik & Co can assist you with achieving your financial goals, please speak to your broker. Or if you're new to Killik & Co, contact us at the details to follow.